All right, let's dive right into Hindustan Unilever's latest quarter. On the surface, the headline numbers looked, well, pretty decent. But the market's reaction? Yeah, that told a completely different story. So we're going to unpack exactly what happened.
And there you have it. That's the number that tells the real story. The stock took a nosedive of more than 3% the day after their earnings call. So what on earth caused all that pessimism? That's the puzzle we're putting together today.
It's the classic head scratcher, isn't it? A company beats profit estimates, but investors run for the hills. How does that even happen? Well, the answer wasn't in the headlines. It was buried in the details of the earnings call and one specific number that completely spooked everyone. Okay, so first things first, let's look at those headline results. And honestly, it's a bit of a mixed bag, which is exactly why the market got whiplash trying to figure it out. So, taking a look here, you see revenue up just a little bit, 2%. Profit after tax, or PAT, was up almost 4%. And you might think, hey, that's not bad. But then your eyes start to drift down that table. You notice the margins got squeezed. And then you land on the bombshell. Volume growth was zero. A big, flat nothing. And that was the red flag everyone was talking about. This really is a tale of two numbers. On one side, you have that good profit number that beat expectations. But it turns out it was kind of propped up by a one-time tax gain. A little bit of accounting help. Well, the smart money on the street saw right through that. They ignored this shiny profit figure and focused on the real issue, that 0% volume growth. That was the real story. So how do you explain a flat line in volume? Well, management was really quick to point the finger at a bunch of external factors. They argued these are just temporary headaches, not some big structural problem with the business. So here's the list of culprits. The big one, according to them, was a major disruption from changes in the GST. It basically caused chaos in their distribution channels as everyone tried to clear out old inventory, and they figured that alone cost them about 2% in volume. You add in a monsoon season that just wouldn't end, plus a pretty weak rural economy, and well, you've got the perfect storm for zero growth. And hey, you don't have to take my word for it. This is straight from the new CEO, Priya Nay. She literally calls it a transitory disruption. The message they were blasting to investors was loud and clear. Relax, this is just a short-term wobble. Nothing is fundamentally broken here. Okay, so enough about the problems, right? What's the plan to fix it? This is where the new CEO tried to pivot the conversation away from this messy quarter and get everyone focused on the long-term strategy to get things moving again. And here's the playbook. 4 key priorities. It's pretty standard stuff, to be honest. First, get smarter about who you're selling to. Second, make your classic brands feel fresh again while also pushing your more expensive premium products. Third, go all in on e-commerce, especially that super fast delivery stuff. And finally, pour your money into the parts of the business that are actually growing fast. This is the roadmap they're selling to Wall Street. Now, looking ahead, this is what they guided to. And the crucial point here is they're signaling a return to normal by early November. They're trying to tell the market the worst is over. The big takeaway is that they expect the second half of the year to be much better than the first, trying to put a floor under expectations. So, management made their case. How did the market take it all in? Well, as we already know, not very well. Any initial positive feeling just fizzled out as soon as analysts started digging into the real numbers. And here's some really important context. Leading up to this earnings release, HWL was actually a star performer. The stock was crushing its sector and the broader market for 3 months. So this outperformance made that sudden drop feel even more jarring. People were not expecting it. I mean, this timeline tells the whole story. The stock initially jumped 3% when the headline profit number hit. Great, right? But then the conference call happened. As investors listened in and realized the profit was a one-off and that volume growth was zero, the whole sentiment just flipped. The optimism completely vanished, leading to that ugly sell-off. So, after digging through all of that, the results, the guidance, the market reaction, what's our take here at Talk Tickers? Here's our official outlook for the next quarter. So where do we go from here? Was this just a one-time stumble for a reliable giant? Or is it actually a warning sign of some deeper issues on the horizon? All right, our official call is a market perform rating. We do think volume is going to bounce back into that 2 to 3% range as all that GST noise finally fades away. But with the rural recovery still pretty slow, we just don't see a major catalyst to make the stock really take off in the near term. The company has to prove it can get volumes growing again before it deserves to trade at a premium.
And now for our outrageous but plausible trade idea. We're thinking a pair trade here. Go long on Huel, but at the same time short a basket of its smaller, weaker competitors. The logic is simple. Even though Huel stumbled, it has the sheer size and operational power to navigate this mess far better than its rivals. This trade is really a bet on Huel's relative strength in a tough environment.
And as always, we have to say it. This is not financial advice.